Is it possible to time a recession or to tell when it's going to happen? Come find out in this video. I'm the Gaussian Snake. Welcome to the crypto simulation. I'm going to talk to you about the stock market and if we can see a recession coming through technical indicators. Please be sure to join our free Telegram group at the Snake Pit if you want the latest crypto market news, technical analysis updates, and new project alpha. We are based completely on market psychology and data-driven approach. We have a vibrant community of almost 220 members, and we would love to have you join us, so be sure to sign up after you're done watching this video. Here's the stock market on the monthly, and so we asked the question, will our technical indicators be enough to tell us when a recession is likely coming, and can we prepare for it in advance? Predicting recessions is notoriously difficult, and it challenges even the most educated economists and analysts out there. But we have a lot of technical indicators that we can choose from, so maybe there's a way we can study past recessions to see if there's something looming in the charts that we could look at to tell us when one is coming again soon. So I'm going to take a look at some past recessions, some very notable ones, and look at the technical indicators. And I also want to point out a couple anomalies in the chart, which are 1966, which was the Vietnam financial crisis, and the 2022 COVID drop, which and this is, of course, after the 2020 COVID drop. This is the 2022 bear market bottom. So that's what I'm referring to. Both in 1966 and 2022, there were elements of things that might be considered to be a recession, but they didn't meet the full criteria for one. So we should look at those and compare those in the context of past recessions. And I think the monthly time frame is a really good time frame to look at. So let's start by looking at some pretty commonly used indicators. We'll start with RSI and stochastic RSI. Just to review, that gives you the direction of price movement, the slope of it, like how high it's going, how steep it's going. So when we have price going up, but it's kind of concave down, we would expect that the RSI would be concave down, but the stochastic RSI would be heading up. Anyways, things like that, or if you're going down, same sort of thing. What can we notice in this indicator that might tell us that a recession is coming? I'm mainly going to be focused on major recessions because there's been many minor ones and there's just way too many to go through, and I'm not going to go through every single recession with every indicator because this video would end up being 10 hours long. But I do want to call up the most recent two recessions, which are the dot-com crash of 2000 to 2002 and also the Great Recession of arguably the end of 2007 through 2009. And you can see on this indicator, the white curve is the RSI, and the blue and orange one represent the stochastic RSI. And you can see that most of the time we spend time up here, and if we do dip, we only dip down maybe to 50 or so. But there have been times where both the RSI and stochastic RSI have dipped really low. Now, what's really interesting is in the 2020 or the 2000 to 2002 bear market that was a dot-com bust. We actually stayed down here for quite some time with low levels in our bear market. I mean, this lasted quite a while where we were down at, and this is getting into some pretty deep drops and negative territory. And you can look that we were down here from December of 2000 to July of 2003. And you can see that we kind of had like an initial drop and then dropped even further. This also happened in the Great Financial Crisis. You can see we dipped down here, but it was actually over a lot more quickly in a certain sense. Once we got down here, we bounced out a lot harder. And then, interestingly, this is like a double bottom, which is a very bullish formation. And certainly we led into some very bullish times with a little bit of a recession scare. So, looking at this data in isolation, I don't really think you can use RSI and stochastic RSI as an indicator that a recession for sure is coming. I mean, it looked like one was coming here in 2015 and it did not materialize. It just turned out to be a recession scare. Now, interestingly, in 2022, we did have that massive drop in stochastic RSI. And even the pandemic wasn't quite this deep. This is recession level deep. However, the RSI was still hovering around, it got down to a low of around, it looks like 42.61, which is low, but not anything to it kind of matched the COVID low. But the RSI itself showed that we actually didn't get as negative as we probably could have, but the stochastic turned down pretty steeply. So this looks a little recessionary, even though it wasn't. You can see we've just kind of barely climbed out of it. Now I'm pulling up the 70s. This is the Nixon Recession. You can see that you notice with these major recessions, there's some pretty steep drops in the RSI and stochastic that take place. And then this here is the oil shock recession, which was a much deeper recession than the Nixon recession. Kind of looks a little bit like a great financial crisis in the RSI metrics. And, if you go even over into the 80s, you can see that we would sometimes dip down briefly. And some of these were considered to be recessions. These were the energy crisis 1 and energy crisis 2 recessions. And honestly, it doesn't look that different from 2022 on the chart. And if you go to the Vietnam financial crisis, look how deep we came, right? And it's kind of interesting to see that this was not a recession, right? This was not a technical recession. It was actually considered to be a soft landing by the Fed. So, but technically, how would you know? I guess it was just a very quick recovery compared to what would come later in 1969 heading into 1970. One thing that you might notice if you just kind of scroll through history to present day is that we spend in the stock market a lot of time at these upper levels once we get up here. I mean, we can spend several years up here, right? We're not immune to little drops here and there, but we had our dip in 2022, and honestly, we're still at pretty elevated levels, and we haven't been up here for really that long after dipping so low. So it does kind of raise a question of are we going to have a recession this year or next year, or is it not going to be for a couple of years? I don't think we can tell off of RSI alone. In fact, we're trying to uncover if there's certain signs in the charts that we might be able to look at, and so far we really haven't seen it. Okay, RSI and stochastics RSI can give us some insight into the length and of recessions and how things go through these sharp drops and stay down for long, but it's certainly not enough. Let's move on to a different indicator. Okay, I'm going to look at the ADX and DI on the monthly. The ADX is the white curve, and that represents the strength of a trend. The higher the value, the stronger the trend. Generally, anything over 20 is considered strong. Something near 80 is about as strong as you get, and you can kind of gradient your way down. Anything below 20 tends to be more on the weak side. The green directional index, when it is diverging away from the red, that is bullish. When it is converging towards the red, that is bearish. When the red is starting to pull away from the green and the green is below it, that is very bearish. So you can see that in the Great Depression, there was a cross in the ADX and DI where the green met the red, and then we had basically a recession take place, and we reached maximum trend strength. And when this started to drop, the recession was basically starting to end, and we pretty much marched our way right into that red Gaussian channel and took off into a slightly better time, right? So it wasn't really that much better. As you can see, we went right back into another period of economic weakness, but it wasn't, we didn't experience this massive drop that we had initially experienced. It almost reminds me of what happened to Bitcoin in 2019. You came out and then went right back into it. So you can see here that the red was above the green, right? And so let's see if this pattern holds throughout recessions. I mean, there are times like here in the 40s where we this wasn't certainly a major kind of event, but you did have some economic weakness. Believe it or not, this actually was a recession. This was the post-war recession. Okay, it was a much briefer one. And then you see these periods of economic expansion that followed in the baby boomer years, right? You do have the situation here in the 50s for just a slight amount of time. This was actually, I believe, the Eisenhower recession right in here. Okay, and so the ADX and DI does seem to be pretty good at spotting these things, although not always necessarily. It looks like right here, I think this was the rolling adjustment recession, and then here you have the Vietnam financial crisis, which by all means looks like a recession, right? But it wasn't one. Okay, and then here you have your Nixon recession. Now, interestingly, this is June of '69. You can see that we started having weakness, though, as the green came down. When the green starts coming down and the trend strength starts to pick up, that is kind of a sign, an ominous sign. Look how high the red got here. Trend strength peaked and we came back down. So I think the ADX and DI is actually a fairly good indicator of recessions. And so it does kind of make you wonder, well, where are we now? So if we go to look at the 90s, what a great time of economic expansion that was. I mean, it was so long till we had a recession. We were just due for one. And we got .com right here. You can see the green and the red crossed, and we got .com. And then we had, this reminds me a little bit of the Great Depression. Like it was like a modern day version of it, where you had a period of economic strength that followed, but it wasn't really more than just sideways action that got us near our last high, and we just dumped again and put in a double bottom. And look how strong this red DI got, even stronger than the last one with equal trend strength. Okay. And then in 2011, there was a little bit of weakness, but it wasn't, you wouldn't call this tiny little blip a recession. Okay. And then we carried through to present day. Notice in 2015, heading in 2016, we did have a little bit of a recession scare, but notice that the white DI, just like here, is really low. When the white DI is low, that means the trend strength is weak. And then it picked up again into a bull market, came down, and then right here is your COVID recession, which actually is pretty significant. But it wasn't very lasting because look at this DI. It was way down. I mean, the ADX. The ADX, and I'm sorry if I called that DI. I meant ADX is way down here, weak trend. And so the ADX picked up again, led us into our bull market and into our bear market. And you can see that if this had been higher, like up here, we probably would have been in a recession, but it wasn't really that high. And now what's happening is you have our green DI forming again at a pretty high level, actually equal to the 2021. And so it does make you wonder what's next. You can see that when we turn green, we tend to stay green for a while, but that doesn't always mean it's up movement. It can be down movement as well. So we had like a tiny recession. I wouldn't even call this a recession. But we had a scare. Then we had an actual recession, and then we had a bear market. I mean, it wasn't a recession. And so it kind of makes you wonder, well, what's next? Usually some time passes, especially when you get this high on the green DI, like if you look at history before you head into another recession. This was a level of like 32, and then we rolled over. It took us, about a year? Let's see, this was May of 2007. Okay, about 6 months or so. And really, the recession started to hit at the end of 2007. So you're going to get concerned when the green starts to converge towards red. That is sort of your warning sign. Especially when it starts to do so in a sustainable way. You probably want to exit the market before these two meet if you suspect a recession might be coming. And what is a little concerning here is that you do have the ADX starting to turn up now. Okay. So it's at a trend strength of 17 where it was pretty flat before. So we'll see if this can kind of pick up steam throughout 2024. And I wonder if we'll take out this high and put in another major high, maybe heading into 2025. Everybody's calling, including I've made calls for a recession at the end of this year or early 2025. But looking at this chart, maybe it gets delayed. Maybe it doesn't happen that quickly. Okay, well, these are two indicators. We should look at more. Okay, this is the average sentiment oscillator, which is similar to the ADX and DI. That's why I showed it next. When the green line is diverging away from the red, that's bullish. When it's converging towards the red, that's bearish. When the red is diverging away from the green and going up, that's bearish. And when the red is going down, that is bullish with the green coming up. And we can see where we're at most recently. We had a cross in June of 2023, and then we started to move up. We had a little pullback, which you can see reflected in the chart. And then we moved up again, and now we're pulling back. And we're actually pulling back a little more sharply than before. Now, what has happened in the past is, okay, you can see here, this was starting in late 2021. This was quite a dip, took us down to the bottom in, looks like around, we actually hit the bottom like around here in October of 2022, even though this was moving down a little bit further, and that represented a bear market. Let's look at what what these patterns look like. Again, this is a monthly time frame in the past. So coming out of one of the most bullish decades ever, right? The 90s. You can see it looked like we were going to have a recession in 1994, but it ended up not happening, and then we just kind of blasted off and stayed at these elevated levels for quite a while. You could see how the bull market started to weaken, and then, things really get bad once you cross, and then the red starts to go up, and you can see that we can track this. These peaks of red corresponded to significant bottoms in the dot-com crash. And then we came out, had a nice bull run. Unfortunately, it just pretty much went sideways. We just went straight back up to our previous top, failed that test, fell into another bear market. And you can see that the bull markets are a lot longer than the bear markets. And then 2010, looked like we were about to cross again in 2012. Didn't happen, went into another bull. We did cross briefly, and this was your recession scare. And then we came back up again and had some, even in 2020, it wasn't enough for us to cross because it happened so quickly, the COVID drop. And then we had this little red period. So the question is, how long are we going to stay elevated? I'm sure it's going to be choppy. And what will that imply? Who knows, right? Let's go back to the 60s. Okay, because I like looking at the 60s because of how similar they look to today. And you can see there are definitely some patterns in common. So if you think of the 50s were a pretty economically strong time for the most part, right? There were these little periods of red, but we spent a lot of time in the green. And then we kind of started coming down, and our red bubble right here was a little bit bigger than some of the previous ones. And this was the Vietnam financial crisis, not really that big, right? Even though it came down and we had, almost had a recession. We bounced out of that fairly quickly. This reminds me a lot of 2022, what happened in 2022 coming out of 2021. Very similar behavior. And then things were relatively good through the 67 until Richard Nixon's election, which was right around here. And then we kind of plunged. And it makes me wonder if something similar might happen this time around. So, I've kept my base case for a recession late 2024, early 2025. And a chart like this would kind of give me a little bit of confidence that maybe that might happen. And you can see this was the Nixon Recession. And we just went into a recessionary decade, which was the opposite of the 50s. You can see we had a little bit of relief, but really just put in kind of a double top, maybe a slightly higher high. And then we put in a lower low. The red average sentiment oscillator got a little bit higher, and you can see we just had this awful decade of recessions, and the oil shock, man, that was bad. That was a bad one. And finally, we kind of crawl our way out of these in the 80s, and then the recessions in the 80s were relatively muted until we hit .com, right? And we've already seen this, and then we hit the GFC. And it certainly looks like we're due for a recession. You can see all this green. And so might this next drop be turn into a bigger one of these red bubbles, kind of like what happened. And doesn't this right here, this chop, 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 kind of look really similar to what happened in the 60s? Look at this chop, 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 chop. Except then it didn't result in much of anything. But perhaps now we get a much bigger, see how these red bubbles grew bigger and bigger in the 60s, in the 70s, and see how we had a little red bubble here. We have a bigger red bubble here. So I think the next bear market to come is going to be stronger than this one. It just seems to be what happens. But that's just speculation, of course. We can't tell a whole lot from the ASO, but it helps us understand kind of these waves of momentum that we get in the market. Okay, this is my price momentum oscillator, and we can go all the way back to the Great Depression, and you can see that when we had our roaring 20s, you'll notice that for price momentum, it was just a series of higher lows and slightly higher highs. And then in August of 1929, we just fell off a cliff, and we were at some really low price momentum levels below this blue line, which you'll see historically doesn't happen very often. And it seems like every time you get one of these major drops, it seems like there's you come back and you test this low again. the Great Depression was so bad that we couldn't even take out this high when we bounced in 1937, and we just came right back down. Now notice we didn't spend as much time here as we did before, and then we spent a lot of time holding the minus 40 level as support before taking off in the 40s just to come right back down again. But notice even shorter amount of time, almost like a triple test of this bottom and price momentum over the course of like over a decade. And then you can see that after that, in the baby boom period, we didn't come below this minus 40 level for a really, really long time. But what tends to happen is you put in these higher lows, and then you start to break down. Maybe like, you know, a little over a decade later, we were getting even closer. And there's your Vietnam financial crisis. We came super close to minus 40, and then we broke it. We broke it in 1970, and then we broke it even lower 4 years later. So you can see like the momentum just gets worse and worse and worse, and then it gets a little bit better. 1978, and then you can see in the 80s, we stayed above it for a while. I mean, we flew above it in the 90s. We got really high. We almost hit 1 in 96, and then, we just started coming down. And we just briefly went underneath negative 40, kind of rode this support for a little while. So this recession, while bad, pales in comparison to the Great Depression. And then boom, we went lower in 2008, 2009. It's almost like it was meant to happen. We went down into levels not seen really since, many decades, at least the 70s, right? And then we started going higher and higher, and we hit that max level in 2017. And then what do you think's going to happen? Well, notice how we're going lower and lower. So maybe in this next presumptive recession, and whenever that is, it could be the end of this year, it could be 2025, or it could be 2026. Maybe we come down and test this minus 40 area. Maybe we hold it as support, and it might not be until the recession after that we break below it in the 2030s. Okay, we can see, that this is just one of many indicators that tells a story. Okay, sometimes the simplest indicators are the ones that are the most powerful. These are just two moving averages. Now, they're not simple moving averages, pun intended. They're whole moving averages, which are a lot more, they're less lagging than SMAs. So the way the mathematics is behind the whole moving average, or HMA as it's called, is that it's looking more at current data than lagging data. So the blue HMA here is the 50-month HMA, which is a very strong HMA. We're talking monthly momentum. And the white HMA is the 100-month HMA. So I'm going to start here in the roaring 20s, and you can see in the roaring 20s, the 50-month HMA was above the 100-month HMA. Trouble really started brewing when we got a death cross of the 50 with the 100. And, normally with SMAs, death crosses don't mean a whole lot. They're lagging. But with HMAs, they're not lagging. They're not very lagging at all. Maybe just slightly lagging. You can see that death cross did spell doom for the S&P, which was the beginning of the Great Depression. And we did have a curvature back out of it to take us to just basically trying to retest this high and failing at this resistance here. And you can see that the HMA, the distance between the HMAs really started to narrow, and we got another death cross. And that was not as extreme as the first one, right? It's almost like, I don't know how to explain this, but sort of like when a ball bounces and then it hits the floor really hard, it's going to bounce up, but it's going to bounce down and then bounce again. But maybe that, that second bounce isn't going to be as like dramatic as the first one. So you can see that in 1938, we had another death cross, right? And then a golden cross in 1943, and then just kind of like some sideways crossing that took place throughout the better part of the 40s, which almost looks like an accumulation phase. And then we started to just work our way up to more bullishness. And we'd have these periods with blue just crisscrossing the white. And that took place over many decades, even into 1966. And you can see tonight, if you were to sort of blow this up, get a better view, these things are a little more dramatic. But, you can see we had some drop-offs, right? For sure. Like in the late 40s, we dropped off. Just nothing as dramatic as the Great Depression. Okay, so we dropped down here, only to come back up, golden cross, bull market, drop down for a little bit, death cross, and a dump, but nothing like really that dramatic, right? Until when? The Nixon years. So we had the Vietnam financial crisis was almost like a warning signal that trouble was brewing, and things got patched over just long enough to take us into, like if you look here, you can see that the 50 month was starting to move back up, and it had a golden cross in September of 1968, and then Nixon was elected president right here in November of 1968, and the market literally topped. And then as this price started to fall, you got your warning signal, your get out signal in December of 1969, and then woof, we just really, the floor fell. But look at these waves. It's like a wave. You come down, you come up, you come down, you come up a little higher, then you really came down, right? This was the oil shock recession, and look at how nasty that was. And then we came up, but this time we came up a little bit lower, and then we did something similar to what we did in the 50s, right? We just started to just ride this. We had some recessions, but they really weren't that bad until we got into the 90s, and we got into some of like the Gulf War stuff, right? But like if we were to like pull this up, make it a little more visible, you can see that it was nothing, a pale in comparison to what happened in the 70s. And it was just like literally freaking straight up in the late 90s. Price came down. You can see that's your warning sign when you came down to the 100 HMA. That trouble's brewing. A few years, or not even a few, like a year later, 1999, we touched the 100 month HMA, and these are starting to narrow. So it's telling you like price is starting to weaken, and you get your death cross. That's your get out signal, right? January of 2001. By then, the dot-com recession had already begun, and you can see a really big drop. Okay, really, really massive drop, and lots of separation. And you have your golden cross heading into 2004, which, by the way, was an election year. And 2000 was also an election year, and everything went to hell right afterwards. So and this was a nasty bear market. This was the dot-com bust, and then you see what happened. We go back up again, right, to test the high, and you can already see that this was a weak bounce heading into 2008. Here's your death cross, get out now, and dropped even harder, went back up into another bull market, right? But you can see here that we actually sliced through this in 2016, and we had a little bit of a death cross. Well, just a little bit of a drop, right? And you've seen these like in the 50s and stuff, like not so bad, right? And then you can see that we were struggling. 2020, we kissed tiny little, this is like a black swan event, but we were already not looking great heading into it. And then we had our bull market into 2022, and then we had our drop. So it looks like we're building up toward a bigger drop, and we still haven't gotten our golden cross yet. So to me, this tells me there's still some juice left in the S&P. I don't think we're done. Doesn't look like we're heading into a recession. But when you get the golden cross, generally you don't stay golden for very long, right? Like when we had this golden cross in 2017, it wasn't that long before we started to lean a little bit bearish again. And, it's like about a year, right, before you start to consider being bearish, or it could be even less time. Like you can see, when will this likely cross? When will we get that golden cross? I'm just guessing by the summer, maybe. Maybe by the summer we get that golden cross, which is usually indicative of some positive price action to come. And honestly, you almost can't make this stuff up. We could see this start to roll over again at the end of this year, election year. So I mean, my base case, based on all this data I'm looking at, is still going to be probable recession end of this year, early next year, right? It just, the data seems to suggest that from many different viewpoints. Now, this video is getting a little bit long, so let's just look at one more indicator, and then we can always come back and do something like this in the future. But, I don't want to overload you, so let's just do one more. Okay, the last one is more of like a storytelling example. I'm actually going to put this on regular arrow. I don't really need the date tool. And we're going to take you through a journey of the entire history of the stock market, all the way from the late 1800s to where we are today. And we're going to do so from the perspective of weighted logarithmic Bollinger Bands, which have grown to be, I just discovered these, I think like last year, and they have grown to be one of my favorite tools for assets. I mean, they're so descriptive and so simple, and sometimes looking at simple things can help. They help you visualize volatility based on how wide or narrow they are, right? This median line, and then you have standard deviations, 2 standard deviations away from the mean, and when these start to really narrow, they're usually a big move is coming. And so you can see in the 1800s, the big move was down. We kind of spilled out into 1878. Made a nice run right back up to retest this high, and ultimately kind of failed. Put in a higher low though, which is a good thing, and then we squeezed once again into the late 1800s, into a bearish bias, right? And then as we got into the early 1900s, you can see how we started. These almost look like intestines. We started this sideways, almost like accumulation period over time, although with a slightly bullish bias at times, slightly bearish bias, and then we head into the roaring 20s. So this is your accumulation phase, and boom, straight up. And you can see how we stayed above. We were chopping around on these weighted logarithmic Bollinger Bands, and then finally in the early 20s, we stayed above this for like quite some time, and that led to a very prosperous time in the American economy, and we peaked. Bull market peak, blow off top in September of 1929, and dead cat bounce April of 1930, and then look, we were underneath. It's like literally made a corner, it rounded out, and we were underneath this. So when this got super wide, like it was here, and we were right at the top of the channel and just constantly riding it, told you we needed some time to cool off. And that time we cooled off was, the Great Depression. And wow, what a cool off that was. Look how volatile of a drop that was. And this is just more of a bounce right here. Double top, came down again in the mid 30s. Again, tried our best. We put in, we were trying to climb our way back up. And like I said, we didn't quite make it. And we came back down again, and yeah, this was the Roosevelt recession, right? Which was an extension in some ways of, it's a tiny depression compared to the Great Depression, right? But the Roosevelt recession was sort of thought of as like the recession within the Depression. So some people consider this to be kind of part of the Great Depression, and you can see that we basically tested the lows from a few years ago, and then the Bollinger Band squeezed, we fell down again, and then like basically, this is like World War II, initially not so great, but wars are good for the economy. So basically until 1945, right, right in here, or is it, or 1946. We started to see in 1945 a little bit of a slowdown, but it was in 1946 that things kind of fell off a cliff into an accumulation phase. Again, it looks like accumulation. But on the whole, this just looks like, you see this little turnover and it's choppy, and then boom, we go back up again, and we had I would call this the post-war recession right here, and then we entered into very bullish times, right? And so, boom, went straight up, and then rolled over into the Eisenhower recession. And you can see the weighted Bollinger Bands, like they would go flat and then go back up again, and it's like they would come down just a little bit, go back up again, squeeze, move to the upside, and then we had a little fallout here. I guess this would be kind of the tail end of the rolling adjustment, although I think the rolling adjustment technically was in this period. This wasn't even, if this was a recession, I don't know which one it was. But this looks like, a little bit of a dump out. And then we went back up again, had another little dump out. This dump out would be known as a Vietnam financial crisis. So this had to be something significant. You can put in the comments exactly what that was. And then you can see kind of like, it almost looks like an accumulation period, right? We went down a little further into Nixon Recession, and then a really big move came right here where the floor fell out. And you can see the Bollinger Bands were squeezing quite a bit, but this looks like a lot of sideways movement. Even this recession looks like sideways movement. And then after that recession, that kind of cleaned the plate off for us to have some nice runs, mainly to the upside. Okay, and then there was another big market drop just for a month in 1987, came back up. And the Gulf War recession, I believe, was around this time. So this is like around the Gulf War. But overall, we're still in like an uptrend. The S&P just does nothing but go up for the most part, right? It's rare that it has periods where it goes down sharply and then boom, off to a massive bull market, and then we fell off a cliff. And you can see that like weakness is coming when you're testing this median line, and you see it start to go kind of like concave down, and then we fell off a cliff. The bounce wasn't as impressive as it could have otherwise been, meaning we didn't have enough downtime, and then you can see what happened. The Bollinger Bands were constricting, and then they widened, and boom, straight down to the bottom, another big move. And then we came out of that, started to have some weakness here, and this is a recession scare. Came up, and we keep testing this like bottom line. It's getting wider, and we went up, and then that didn't hold. And so you can almost sense like there's a big move coming, and it's probably going to be to the downside. But is this going to be the big move? I'm not so sure, right? So it looks like here we are again turning up after kind of turning down during 2022, and you can see this drop looks like almost nothing compared to what we've seen in the past. It's understandable why this wouldn't really reflect a recession, although we did have 2 consecutive quarters of negative GDP. Look at this, we came back and we tested the median line in November 2023, and now we've been riding the top of the channel. Looks like we're going to come back and possibly test it again, and that could happen maybe in May. My prediction is we keep going up after that. Like, I don't think this is just going to roll right over. But notice that the Bollinger Bands are getting wider, but this median line has turned up. Prevailing momentum is positive. And if you overlay this indicator with the Gaussian channel, you can see kind of like the lagging momentum along with this current momentum. Looking at past recessions, you can see one of the warning signs is not only is your weighted logarithmic Bollinger Band turned down, but you enter the top part of the Gaussian channel aggressively, then you ride this median line for a little while, and ultimately you lose it as support. And then you come down below it, and when you're away from the Gaussian channel, it's going to pull you right back in. And you can see here the warning sign is entering the top part of the Gaussian, then you sliced right down to the, like if you enter it without much trouble, like we were doing here, you see that first big red candle, that's your like get out now sign, you're probably dumping. And we have actually managed to stay off the Gaussian channel for the most part, other than this COVID wick, which was just a wick, right? This was just a wick, and this was a candle, but it was a green candle. And you can see we tapped it in October 2022. All we did is just tap it, and now we're pretty far away from it. We're actually putting in a higher high, slightly higher high, and I think we go higher from here. I do. I don't think this is it. So, but the Gaussian channel is concave down and widening, indicating that there is some weakness. You can see when you have wide Gaussian channel, it's generally and it's starting to go concave down, generally not a great thing. We've talked about this in previous videos. Let's take a look at what this looked like in the 70s. So you can see coming off the post-war boom, we had a nice trip above the Gaussian channel. Weighted logarithmic Bollinger Bands were up, concave up Gaussian channel, very narrow, which is good. You like to see that. There's not much volatility. And then just really taking off above it. And it looked like we were about to slice through it in the late 50s, but we didn't. We just came close to it, continued right back up. It looked like we were going to come close to it again in the 60s. We ended up putting in a higher low, slightly higher high, and then we fell into it. But amazingly, we held it as support. Bitcoin is doing something similar to this right now on the daily as I'm making this video. So this is something I am watching with Bitcoin. Of course, Bitcoin looks different over here. It looks very ominous on the daily compared to the S&P in the early 60s. But when you hold the Gaussian channel line like this, that's a bullish sign. It took off again, and it came back in the Vietnam financial crisis, and guess what? It held the median line there too. Jumped off again, tagged the top line, did just great, and finally the floor fell out. It looked like it was going to hold, right? But that first candle through was your warning sign. Get out. Just a few months. This was in February of 1970. So yeah, we were already well into the Nixon Recession. You know, you just never know. Like when you penetrate the green Gaussian channel, exactly how things are going to go. But it was kind of concave down, widening, and that led into some weakness. And you can see here we actually flipped this red because of all this momentum that happened so quickly. And then we really got the floor falling out, so sliced right through that channel. And it almost seems like you need these kind of things to happen every so often to keep the bull market intact, the larger like 100 plus year bull market. And you can see we went into an accumulation phase. And then in the 80s, we did this testing thing, but it was a more bullish kind of testing, like a back testing almost. And then we saw the weakening of the structure in the late 90s right here. You see we sliced through, and then we hadn't tested this in like forever. And we can see that it was starting to widen, and boom, we just sliced right through it. Yeah. So similar thing happened in the 80s that happened in the 50s and late 40s and 50s leading up to the 60s. So we could also look at what happened maybe even leading up to the Great Depression. The Great Depression looks really similar to what happened in the late 90s heading into .com, doesn't it? Like we just went way over here, just blasted way off, and then had a sharp candle, a couple really sharp candles down. You always get this dead cat bounce to try to test for bullishness. We failed at the weighted logarithmic Bollinger median line, just sliced right through, and that's all she wrote. So, but I mentioned this in a previous video about recessions. These truly major recessions don't come around very often. We've seen it in the Great Depression years, we've seen it in the Nixon years, and we've seen it in the Obama years and the George Bush years. So, and that's like we're in 2024, so it was only 16 years ago. These super major recessions only seem to come around once every like 30 years or so, give or take, that you get into this like recessionary decade. And if we go look at our chart now, let's see what it looks like. I mean, honestly, it doesn't look that bad, right? Like it just looks like another one of these time periods where we're in a longer term bull market. So if we do see a recession, and I'm not saying that we're not going to see one, there's a chance that it doesn't come for a while. Like it's really hard to predict these things. The Gaussian channel is concave down, but if we blast off here, it's going to go concave up again. So this just shows you that, like, to answer my original question, which is when are we going to get a recession? Unfortunately, my answer is it depends on what you're looking at. But overall, it doesn't seem like in some metrics, it looks like a recession could be here by the end of this year, early 2025. Something similar to what happened when Richard Nixon was elected, right? We could see something like that. We could see this kind of like come up here and maybe just put in a slightly higher high than, or just take out this high. I don't know exactly how that might play out. But what we have to really watch out for when you're talking about a major recession, right? Truly major recession is usually you stay above, like you saw this happen in the Roaring 20s. We were just above this Gaussian channel. We weren't even testing it for like almost a decade, right? And that's the same thing that happened in the Roaring 20s. Now, heading into the inflationary decade of the 70s, if we go back there, you can see that we actually touched the Gaussian channel quite a few times, right? In the late 40s, we touched it. We would come back and touch it. So actually, it's healthier when you do this, when you come back and you touch and you take off. And it seems like the time period we're in now in the 2020s is more similar to the 1950s, like in a lot of ways, like maybe the late 50s heading into the early to mid 60s, somewhere in there. I can't tell you exactly where we are. I mean, I think it's reasonable to think we could be somewhere like here, right? So but I'm just saying, like, the time period from the Great Recession.com to where we are now, that long 14-year period, I would say the 1950s might have represented like the first part of that, and now we're in the 60s. And I feel like this might have been like, I mean, 2022 looks more like this than it does like this, right? 1966 actually penetrated the Gaussian channel. But you can see some similarities, right? Like we had a high here. This was like a double top. That happened in 1967. And then we came and we touched the Gaussian channel and we put in a slightly higher high. And then we rolled over straight into a recession in the late 60s. So we could see something like this play out. But I think even if we do get a recession at the end of this year or in 2025, I don't think it's going to be a devastating recession like how everybody's been calling it. I think we might see something like this because you can see that these devastating ones usually take momentum to build over time. Like this is almost like a recession within a recession, like a warning sign that there's probably something more ominous coming in a few years from now. So I think we could see something like this, and maybe we hobble our way out of it to either a slightly higher high or maybe a double top. And that would be, you know, if this is 1973, then that might correspond, assuming that we're in 1968 right now. You know, 1968 would be like right in here. And assuming, you know, we still have all this bull market still to do, like this is kind of where we're at. Maybe we're, you know, taking a little bit of a breather, which ironically was March and April, right? Here's April coming down, so similar. And then we have a great summer with the stock market, cool off a little bit in September. And then maybe we put in our top around November, right when the presidential election is. And that's when we start our recession. You know, that's kind of been my base case. And I don't know, I just kind of stick to that end of this year, early next year. But I think, like, look at this recession, like for the stock market back in the 60s, measured move from the top to the bottom was like a 36.5% drop. So, you know, it's kind of hard to quantify that in today's terms because we have diminished volatility. You know, maybe we see like a double-digit drop. But, you know, this recession took place over about 2 years. It was a big recession, don't get me wrong. Something like this is painful. And plus, this wasn't coming off of like all these years of quantitative easing, you know, where we had like money just being pumped in the economy. But it just seems like from like a waveform point of view that these things can take some time to materialize. The second recession, the oil shock recession, I mean, that one was much more brutal. That one put in almost a 50% drop. A 50% drop in the stock market nowadays is absolutely unthinkable, right? It's unfathomable. What about .com? What kind of drop was that? So we had to scroll ahead quite a bit. I think this is the top right here. So top to bottom, .com was around 50% drop. It's huge. 50% drop, right? And then what about GFC? GFC sorry, I'm having a little trouble seeing here. It was like a 60% drop, I think. Let me try that again. Let me push this up a little bit so I can get a better view. Sorry, let me grab that ruler tool. Yeah, it's like a 58% drop, more substantial drop. And then you can see in 2011 we come back and test the integrity of this uptrend, and we were successful at testing it. You know, compare this to like the COVID crash, which was pretty extreme, right? If you went through it, that was no joke. That was like a 36% drop, equivalent almost to, I think, the first recession of the Nixon years. And if you go to 2022, which was not a recession, just a bear market, sort of an artifact of the COVID drop, right? That only touched the top of the Gaussian channel. That was like it's a little hard to tell here because I think I have a magnet tool turned on. But anyways, about a 25% drop. So not recessionary. So yeah, I mean, we could see maybe the stock market heading into November, put in a high, maybe test 6,000. I think 6,000 would be kind of a good psychological level, or 5,800, and then start to roll over. And you can already see this is kind of widening. So maybe, you know, we get a recession that takes, hard to say exactly where we would be at that time, but maybe we come back and we could test maybe somewhere north of the COVID lows or something like that, and that might be it, right? And then we head back up again, and I'm thinking that we might be entering into a recessionary decade. That's more like the 70s than maybe like the 2000s, and you know, it's not a good thing if that happens, but it makes a lot of sense when you think about inflation. If the Fed can't get inflation under control, because inflation is what caused the 1970s recessions. We've got oil prices going up, you know, which is never a good thing. So, but I think the most important lesson from this is that none of us can really truly predict a recession, but you can look at the indicators and see certain patterns that have played out throughout history, study them, and look for similar ones. But ultimately, the market is a stochastic random process. So I'm still going to stick with my end of year 2024, early 2025 post-election prediction. I see enough concerning things in the data, and maybe we can go through some of those in another video. This one's already long enough. But yeah, that's pretty much my thoughts. I'm going to stick to those thoughts. You can watch my part 1 and part 2, which I made a few months ago, of the recession series, and then make your mind up for yourself. Thanks again for joining me on this informative video about recessions and technical indicators. Please feel free to join my Telegram group. It's completely free, the Snake Pit, SNEK. There's a link in the video description below. And I give you the latest crypto and broader market news. I have some really smart members and admins who also share and new project information. So a lot of people there are members of bigger channels that they pay for, and they will share the information with us, which is really nice, and daily technical analysis updates by yours truly. I have an alerts channel that be sure to subscribe to that. You know, and I also have a portfolio management tool, which I give out for free. Just feel free to ask about that. I've got a risk management series, all kinds of great stuff. Join in the free Telegram group. I do way more updates there. I'm more active in there than I am anywhere else. So this is Crypto Simulation Theory. I am the Gaussian Snake. Be sure to like, subscribe, and comment to my video, and hit that notification bell to be notified of future video releases. It really helps. You hear all YouTubers say this, but it does help with the algorithm to push my content out to more people. Yeah, that's a good thing. So I look forward to seeing you in my next video. I hope you have a great time. Try not to freak out right now. I know the markets are not that fun at the moment, but we've just come off of a really nice bullish run. So we need a little bit of time to cool off. Don't worry, the bullish times will be back soon. All right, until next time, see ya, take care.